Good morning, everybody, and welcome to this seminar on pension choice, how people make pension choices, and how we perhaps can improve people making pension choices. My name is Annika Sundén, and I will be moderating this seminar. I was just thinking when I was looking at the speaker slides and preparing for this morning that, you know, I've been working on these issues for 25 years almost. It's almost 25 years since the premium pension was introduced in Sweden. And it's going to be very interesting to take stock this morning and see how far we've come and how far we've come in discussions and if choices actually have improved. And to do this, we have a very knowledgeable panel that will present, and then we will have a discussion at the end. And you will also get a chance to pose questions at the end. So we're going to talk about today the research about pension choice. What does it look like? What does it say? What are the actual outcomes? What are the actual outcomes in Sweden in the premium pension? And what can we do? What does the pension agency here in Sweden do to foster a more financially secure retirement? So first, I want to welcome and be very happy to have Professor James Choi here, professor at Yale School of Management, and you worked extensively on household finance and behavioral finance, and your research has actually affected how retirement policy looks like in the US, I would say, and how corporations have implemented 401k plans, the equivalent of a similar plan to the premium pension that's provided by employers in the US. So, Professor Choi, the floor is yours.
Well, thank you for that welcome, and it is wonderful to be here with you in beautiful Stockholm this morning. And I'm going to jump right into this question of how can we improve pension choices. And if we want to talk about this, I think it's helpful to divide up the possible universe of pension choices into contributions, allocation across broad asset classes, and then choices of funds within the asset class. So contributions, we're really talking about savings rates. So what does economic theory have to say about optimal savings rates? Well, there are three considerations that standard theory says should be in play when you're thinking about how much you should save in a given time period. So one is this notion that each additional krona of spending gives you less pleasure than the prior krona of spending. So if you have 7 Swedish meatballs, then the 7th meatball is not as satisfying as the 6th meatball, which is not as satisfying as the 5th meatball. And therefore, instead of eating 21 meatballs for breakfast and then having 0 for lunch and dinner, wouldn't life be much more pleasant if you just had 7 meatballs at each meal? Similarly, we would, all else equal, like to have a smooth level of consumption over time so that we are neither overindulged in one period nor deprived in the next. Second, generically as a species, we are impatient. So we value a unit of pleasure that comes earlier, a unit of happiness that comes earlier, more than the unit of happiness that comes in the future, which might not come at all because, you know, who knows, we might get hit by a bus between now and when that promised pleasure is going to arrive. So this is going to actually move us away from perfectly smoothing our consumption over time, having the same level of consumption every period, and maybe tilting us a little bit towards higher consumption early, and therefore, because there is a budget constraint, you must have lower consumption later on. And then the third consideration tilts our consumption in the opposite way, and this is the fact that on average, we are rewarded for delaying gratification. On average, the returns from investment are positive, and therefore that's going to motivate us to actually consume less today, and therefore save that extra, and then consume more in the future, not just from the income that we would get from our labor income and any kind of retirement benefits, but also because of the investment returns from our savings. So you put all that together, and actually economic theory does not directly provide a recommendation for your savings rate. What economic theory does is it provides you a theory on what your optimal level of consumption should be every period. And then the amount you should save is whatever the difference happens to be between your income in that period and what the theory says your consumption level should be in the period. So when your income is low, then all else equal, you should be saving less. And when your income is high, all else equal, you should be saving more. And in particular, what that means is that if you are young, most people have a relatively low income relative to their lifetime level of income. And when you're older, you have a higher level of income relative to your lifetime income. And this is true in Sweden, just as it is in many, many other countries in the world, where in fact you do see an upward sloping path of income with respect to your age. So what that would suggest is that if you had kind of those second two motives, the impatience motive and the investment return motive exactly cancel out, which is a leading case, then you want an exactly flat path of consumption over your life cycle. And that means that when you are young, you want to save very little or even borrow. And then when you are old, you want to have a very high savings rate. Of course, life is more complicated than that. And in particular, most of us will have a partner, will have children, and these people cost money. So here is one kind of very rough formula to give us a sense of what it costs to have these other people in our household. So suppose you have a single person that is spending some amount C. Well, in order to deliver the same per capita living standard to each member of the household that this single person spending C is spending in a year, then what's the adjustment that you make? Well, A here is the number of adults in the household, K is the number of kids. So you multiply C by this expression, which is a little bit ugly in the beginning when you first glance at it, in order to make that adjustment. So let's just take the case where there are 2 adults in the household, no kids. So A is 0, A is 2, K is 0. So you might have thought naively, 2 adults, it's going to cost twice as much money to deliver the same per capita income or living standard to these 2 adults as it does for that single adult spending C. But that's actually not the case. So what you do actually is you multiply by 2 raised to the 0.75 power, which is going to be less than 2. What that's reflecting is there's some economies of scale in the household. So it doesn't actually cost twice as much to supply 2 adults with the living standard of the single individual. Now, K here, we're multiplying K by 0.7. That means that it is cheaper to satisfy kids than adults. So a kid is kind of 30% cheaper than an adult to supply living standard 2. And so you kind of do this adjustment. And so let's just do a concrete example. So say there's a single person spending 300,000 krona per year. How much does it cost for the 2 adult, 2 kid household to achieve the same level of living standard as this single person? It'll be the $300,000 krona times the 2 plus the 0.7 multiplied by the 2 kids, raised to the 0.75 power. So we are talking about 2.5 times the amount of spending for the single person to have this household of 4 people enjoy the same living standard. Okay, so what that means is optimally, when you are in this portion of the life cycle where many people have kids and your income is rising, actually, your savings rate should not, according to economic theory, be rising kind of in tandem with this, because at this point your expenses are higher. Counterintuitively, what the theory also says is that for somebody who lives in a multi-person household where maybe there's only one primary earner, they should be saving less over their entire life. And that's because when you have to spend to support multiple people in a household, given a certain level of income, then relative to a household that has only a single person and has the same level of income, the per capita living standard of the adults is just going to be lower because there are just fewer resources available per capita for a person in the household. And that means that, optimally speaking, when we smooth the consumption over the life cycle, these adults in the multi-person household are going to have a lower living standard in retirement. That means that they need to save less in order to sustain that lower living standard in retirement. So overall, the multi-person household should have a lower savings rate than the single-person household that has the exact same income. So just to kind of summarize what I just have covered, economic theory says that a savings rate for a household should optimally increase on average with age, and it should decrease with the number of children. Now, my understanding is that the Swedish pension system does not have contributions that vary in this way. In fact, the contribution rates over the course of the life cycle seem to be relatively flat and constant. And there's this tension here. Actually, what the Swedish pension system contribution rate corresponds to is something that is closer to what non-economists would recommend for what savings rates should look like over the life cycle. Economists say you should smooth your consumption level over your life cycle. The lay personal finance gurus say that you should smooth your savings rate over your life cycle. So no matter what happens, save 10%, save 15% of your income through thick and thin. And what are the reasons they give for this advice? One is that compound interest is powerful. The most powerful force in the universe, supposedly Einstein said. He almost certainly did not say that, but it sounds pretty cool. So compound interest is powerful. Therefore, you must start saving as early as possible. Second, you need to build a discipline of saving. So saving is like a virtue that is sustained through the practice of it. So if you are trying to save for the first time in your life at age 37, then you're just not going to be able to unless you have already spent your early adult years learning to live beneath your means. Now, how does economic theory kind of interface with these two justifications? So on the compound interest part, that whole consumption smoothing solution, it takes compound interest into account, and it nonetheless recommends a relatively low savings rate or even negative savings rate early in life. On the second point, I think that this is actually an important blind spot in economics, potentially. So in economic theory, the standard economic theory, there is no such thing as limited willpower. You decide you're going to do something, something is right to do, you're going to do it. Now, there are some modifications of that standard theory that does account for some maybe limited willpower, but it's never in the sense that you build a virtue of willpower, that you practice living under your means, and therefore you become more able to live under your means. So I think this is just a really interesting area for research going forward. But at the moment, we're really in kind of the consumption smoothing framework within the standard economic theory. Now, you could imagine a Swedish pension system that has a contribution rate that does change with age, and that, if you have a larger household size, has a lower contribution rate. And this could actually become a fairly involved and complicated formula. So, I think that there is actually a virtue to simplicity and to things that are easy to explain, things that are easy to defend. And so I don't know if it's exactly the right thing to do to kind of do the calculations and say, with a household of 3 children and 2 adults versus a household with 5 children and 1 adult, we're going to very finely tune your contribution to the pension system according to that. Maybe you don't want to go so far, but I think that there is maybe scope to think about simple rules that might move savings rates across the life cycle and across household composition a little bit towards what the economic theory prescribes. And I think that that's something worth thinking about. Let's talk about allocation across asset classes. The right allocation to equities depends, of course, on how risk tolerant you are. Now, over the decades, economists have come to a common agreement that there is a person who is as risk averse as is possibly reasonable, and anybody more risk averse than this is just kind of insane. Okay, so this person who is almost unreasonably risk averse is completely indifferent between these two choices. So choice one, you have a 50% chance of winning 512,000 krona and a 50% chance of winning 1.024 million krona, or 553,000 krona for sure. So this almost insanely risk-averse person says, these two prospects, I'm exactly as happy receiving either. Now, what does this mean? Well, if you compare the sure option to this gamble, this person's saying, well, on the upside, I need an 85% potential return in order to compensate me for the 50% potential of a negative 7% downside return. So you can see that this is a very lopsided gamble that they require in order to be moved off of the sure thing. So economists say, this is a little bit insane, but sure, you can do that. Now, for the economists in the room, what does this correspond to? This is someone who has a relative risk aversion of 10, which we've all decided is the upper limit of reasonable. Okay, so let's take this almost insanely risk-averse person and put them into the US labor market. And in fact, we're going to also suppose that the average return on the stock market is only 4% above the return on the risk-free asset. So this is about half of the historical performance of the US stock market above the Treasury. So the US labor market, of course, is also famously risky, and we have a weak social safety net. So this is a situation where you might think that this really insanely risk-averse individual might want to pull back on his or her asset allocation to stocks. But in fact, what the standard theory says is that this person should have a 100% allocation to stocks. In fact, they would like to lever up and have more than 100% allocation to the stock market through their 50s. What is going on here? It's because for almost all of us, for most of our life cycle, the most important economic asset that we have is our human capital, the future labor income that we are going to earn in our coming years. And that labor income stream acts a lot like a bond. Its growth is not very much correlated with the stock market's returns. So we have this enormous implicit fixed income position embodied in our human capital. And that means that we can take, in fact, we should take a large amount of risk in our financial portfolios because we have this human capital to fall back upon. Now, as we get older, of course, we have fewer and fewer future labor income payments coming to us, so the value of our human capital shrinks, the implicit fixed income position we have shrinks, and then we should be de-risking our financial portfolio to compensate for the fact that our safe human capital is being contracted over time. And so that is a justification for the common practice of these glide paths over the life cycle, where you start off very aggressive in your financial portfolio and then become more conservative as you approach retirement. In fact, this is what the default AP7 fund does, a 125% equity position through age 55, so that it's borrowing 25% of its net asset value, using that to invest in equities, and then that equity exposure declines gradually from age 55 to 75, ending with an overall exposure of 42% equities. You might have thought it's lower, but because of the leverage in the fund, it's actually a 42% equity position at age 75. So that sounds kind of aggressive, except that you have to remember that the premium pension in which this fund lives in is just a small portion of the household's overall balance sheet. It's a small portion of the pension benefits they get. So the household is actually not taking on that much risk, even with this 125% equity exposure through the AP7 fund for most of their life. You might say that this is in keeping with Swedish people's preferences, that they would rather have more safety than take advantage of a potential equity premium going forward through higher leverage. To which I'll say, well, it really depends upon what your objective is. And we, as economists, have already decided that individual from a few slides ago is almost insanely risk averse. And even with the insane level of risk aversion, you still have this 100% equity allocation for the entire portfolio. This person in the models has no other pension to fall back on. The entire portfolio, 100% equities for most of their life. And so there's this question of whether there is scope, there's justification to make the pension allocations overall in the Swedish system more aggressive, higher risk. Finally, let me talk about the choice of funds within each broad asset class. The celebrated economist Ken French, many years ago, in his American Finance Association presidential address, computed what is the aggregate level of underperformance for actively managed investment strategies versus passive investment strategies. And so what this graph shows is per year, what is that aggregate underperformance of active strategies, and on average, it's 0.67 percentage points per year. So for those of us who are thinking about engaging in an actively managed investment strategy, this is kind of discouraging, but not too discouraging because, of course, we are not going to be investing in the average fund ourselves. We are going to choose only the best funds. Now, the question is, how are we going to choose the best funds? Well, I think that there is an obvious strategy that works in almost every domain of life, which is if you are picking a football team, you should pick the players who have had excellent performance recently. You're choosing a fund manager, you choose the manager that has had excellent performance recently. So how does this work out in practice? So I've done an exercise that was done many years ago, but I've updated it to a more recent period, where every January, and we're talking now about US equity mutual funds as the universe here, we sort all the actively managed US equity funds based on their past 12-month return. And the winner portfolio in the graph I'm going to show you is going to be an equal allocation to each fund in the top 10% of the past year return distribution. And the loser portfolio are the funds that performed the worst, the 10% worst funds over the past year. And we're just going to hold this portfolio for a year, and then the following January, we're going to sort the funds again, and then choose a new set of winner funds and loser funds. We're just going to do that every single year. What I'm showing you here is on the horizontal axis is the 10 years period ending in the year indicated on the label. And on the vertical axis is what is the monthly one-factor alpha, in other words, a technical term for overperformance of the winner portfolio, the loser portfolio. Green is the winner portfolio, red is the loser portfolio, and I'm happy to announce that Santa Claus is real, that in fact, if you choose the best performing funds, then you will have better performance going forward, which all of us are told is a stupid thing to believe. Actually, it's true, or it was true, but actually if you follow this strategy forward, it stopped being true kind of in the middle of the sample period. In fact, the winner portfolio starts doing worse than the loser portfolio right around here. So this is 2012. And what that 2012 is the 10 years ending in 2012. So from 2003 to 2012, if you had invested in the 10% of the best performing funds over the past year, you would have done worse than choosing the absolute worst 10% of the funds from their past 1 year performance. And so at least for 20 plus years, this choosing the past winner strategy has not worked. It's been even worse than choosing the worst performing funds over the past year. So, my MBA students, they gravitate toward this. I'm sure that the vast majority of people in the retail investment fund market gravitate towards this strategy of picking the best recent performers. Just hasn't really paid off. What about a different strategy? What if we look at expense ratios? Again, in almost every domain of life, when things are more expensive, there's a good reason they are higher quality. So what if we now sort funds based upon their expense ratio and see how does the expense ratio predict their return over the next year? So what this horizontal axis is again in the 10-year period ending in the year that is indicated on the horizontal axis. The vertical axis point indicates what is the relationship between a 1 unit higher expense ratio and the one-factor alpha, or the outperformance going forward. So you can see that in the 10-year period ending in 1974, a 1 unit increase in the expense ratio results in almost a full 1 unit reduction in the one-factor alpha. Okay, so almost complete crowd out of the final performance delivered to the end investor from a higher expense ratio. And this thing moves around over time. But if you compute the average across the entire sample period, this -1 corresponds to the full 1-for-1 crowd out of performance by expenses. The average is almost exactly -1. Okay, so over the entire sample period, it does not appear that you get anything extra for a more expensive fund. In fact, you are just purely losing out on average from paying higher fund fees. The area where it's kind of the most obvious that higher expenses should result in lower performance is things like index funds. So the S&P 500 index fund sector is a sector where all the funds are trying to match the same return, the same basket of stocks returns before the fees are taken out. So the only difference that really matters in this sector is how much fees are being charged for this replication strategy. What this graph shows you over time is how much dispersion is there in the fees that are charged by the S&P 500 index fund sector. The dark gray bars here, or band here, represents the 25th to 75th percentile range of fees. The medium gray is the 10th to 90th percentile range of fees, and the light gray indicates the 1st to the 99th percentile range of fees. So you can see that as the decades have moved on, there's been no sign of compression in the range of fees that are charged by the S&P 500 fund universe, although you might have thought the competition should be beating all these fees down to the same level. No, pretty much the same or even getting worse. Not all is a disaster in the mutual fund choice world. So if you look at what fraction of assets are in the cheapest 25% of funds versus the most expensive 3/4 of funds, well, actually, the majority of assets are gravitating towards cheaper funds. And that's both the case for actively managed funds and for index funds. So there is some fee sensitivity, actually maybe a considerable amount of fee sensitivity in the market. But I would argue that probably a good portion of that fee sensitivity is not arising because of smart choices being made by individual investors. New Hampshire is one of the 50 states in the United States. The official state motto of New Hampshire is live free or die. It is part of the American national self-conception that we value freedom to a great degree, and therefore we will sometimes live free and die, and sometimes we will live free and therefore die. But there is something to be said about the freedom to choose your own destiny and the freedom to screw up your own life, at least within limits. So I don't know if over in Europe you guys have the same conception of Americans as we have of ourselves. If you do, then you might be surprised to learn that even in the US, we do not let people freely choose whatever mutual fund they want in their retirement savings accounts, at least within a certain sector. So in the 401k space, so this is like the occupational pension in Sweden. This is the most important work-based pension savings scheme in the United States. The sponsoring employer of the 401k plan has a fiduciary duty to their employees that they must act solely in their best interest, solely in the employee's best interest in constructing the fund's investment options and other features of the fund. And what does it mean legally to act in their best interest? Well, so the menu must have enough options so that employees can diversify their investments. And the employees must only pay reasonable plan expenses. Of course, it's vague exactly what it means to be a reasonable level plan expense. But over the past few years, there have been a large number of lawsuits that have been filed against employers alleging that the fees that were being charged by the investment options in the investment menu were unreasonable, and $150 million so far in this 3-year period has been spent by employers to settle these lawsuits. So you could imagine a pension scheme that rather severely restricts the choices that are available to the employees, the individuals in the scheme. And I know that this has been part of the active policy discussion in Sweden. I think that there is a value to freedom. There's a non-instrumental value to freedom. So beyond the results that you get from your freedom to choose, that people just like the fact that you can choose yourself. But exactly where the balance lies between providing that non-instrumental value of freedom, and there is also an instrumental value of freedom in the sense that I can customize my investment choices in accordance with my own needs. Kind of where does that value lie, or how much value do you put on that, versus saying, we just don't want really, really bad things to happen to you, and so we're going to curate the menu of choices so that we don't have to come and rescue you or watch you suffer as a result of your own bad choices. And kind of the balance between that, I think it is a matter of national values, societal values. But even in the U.S., we say there's a certain amount of choice that we're not going to allow you to have because we think that bad things are going to happen. So to summarize, 3 possible thoughts on how the Swedish pension system might change over time. So one is this notion that we might want to change the contribution rates to the pension according to your age, according to your household size. And this could have the benefit of reducing financial hardship for people who are young and might have relatively low income. Say, we're going to push the bulk of your saving into your later years when you have higher income, when you have more financial means to be able to save. And also, this could actually encourage people to have more children because in a portion of their lives where they have high expenses due to childcare, you are also reducing the forced savings that is happening through the childcare during the childbearing years. There's a question of whether we might want to increase the risk taking in the pension investments. And then finally, a question about whether there is more restriction that is warranted in the pension investment fund menu. Thank you.
Thank you very much, James. Thank you very much for a very interesting presentation. And we will come back to your questions in the panel discussion. But next, I want to welcome Anders onto the stage. Anders is a researcher here at the Swedish House of Finance and an associate professor at the Stockholm School of Economics. And you've researched the premium pension extensively in Sweden. And you're going to tell us about what it looks like.
Sure.
Thank you.
Thank you very much. Thanks for inviting me. So I was asked to bridge this excellent presentation from James and going into the Swedish pension system. So I think I'm going to start off just by giving an historical overview, and then I'll talk a little bit about my research myself. So today, the system is about 2,100 billion. So if you count the default fund and all these different funds together, I think that you can place this pension system among the top 20 in the world. So it's fairly large. But I want to draw your attention to some big changes or big events during this 25 years. So at launch, as Annika was alluding to, there was this big information campaign. So Thaler would call this the do-it-yourself nudge. So a lot of people actually made an active choice. 2/3 did. There were 465 funds to choose from. And if you look in the years after, activity fell a lot, but then it sort of picked up, which people saw like this might be a good thing. But it turned out that this sort of went out of hand. This was mostly driven by telemarketing advisors and sort of mass changes, and this was eventually stopped by the pension agency. At this point in time, there were like 800 funds offered, and as you can see that the activity in the system fell back more or less to sort of pre-telemarketing advisor levels after that. Now, following some scandals later on, in 1819, the system was revamped. There was a cap on assets under management, and around 500 funds are now offered. It's now procured by the Swedish Fund Selection Agency, and I think going forward, the idea is there's going to be fewer and fewer funds. I like to think about this like the Systembolaget solution of the pension problem. Nevertheless, so that's sort of a brief historic background. Turning to my own research, so we actually made a survey on people in the system a couple of years ago, and what we did was that we solicited the financial literacy test. This is a 5 basic 5-question basic test on financial knowledge. I plot the distribution here of the outcome of the scores, and you can also see that there are a couple of things to note here. I think the first one is that on average, Swedes are pretty well equipped with financial knowledge, at least compared to in a sort of international context. But you can also see that there's a great difference here in how people behave in the pension system. So people with low knowledge typically wind up in the default fund, and this is something you probably want to see. But you can also see that this is also driven by financial disengagement. So I plot here also the people that report that they never check their pension, and these are very much overrepresented in the group with low financial literacy. What is also interesting to see is that if you look at the activity outside of the system, so we have data on whether you own stocks or not, you can see that it's the people with very high financial knowledge, they also have financial assets outside of the system. Now, you can do more than only look at the scores, and that's the idea behind the research I've been conducting, and this is done with David Robinson and Forrest Baker, I should say. So what you could do is that you can also ask people how sure you are that you get a specific score, and then so you would sort of build a probability bound around your self-assessment of how much you know. And in this graph, I just sorted this on the outcome of actual score, and then I put the full sort of average probability distribution. So what emerges here, I think, is that you have basically 3 categories of people. So those who, you see there are peaks here, so there's a big peak at 5, so these are people that they know, so to speak. You have also a peak here, or those at 0, those are the people that know that they don't know. But then you have, I think quite a surprisingly flat distribution across scores. So people don't basically know what they know. And this is sort of quite important in many settings, we think. One thing that you could do with this is that you can sort of plot the average self-assessment against your actual outcome. So if everyone would be perfectly calibrated, you would expect them to fall on this 45-degree line between actual score and perceived score. And as what you can see is that this is typically not the case. So people that have low scores, they typically overestimate their own knowledge. And people that has high scores, they are much better calibrated. And this has been documented in many settings. It's called the Dunning-Kruger effect related to metacognition. So it's very difficult to have opinions about what you don't know, and this is then could be sort of decisive in many settings where in decision making. So that's where we're coming from this behavioral perspective when we look at pension savings. Okay. Now, I want to relate back a little bit to what James talked about fees and past performance. So this is something that has been entertaining, the financial sector and academia for a very, very long time. But so we asked people, so we've done a couple of surveys. So one is from a US LinkedIn sample. And you would think, so this is not the representative sample of US citizens, right? These would be white collar, tech finance workers. But still, if you ask them whether past returns are more important than fees when selecting a fund, most people actually agree to the statement that past performance is more important, which was a little bit surprising to me. So we repeated this question in Sweden, and this is now a random sample between people for people between 18 and 65, and it's pretty much the same, which is a bit surprising. So what you can do here is that you could combine these two graphs, and what you see here then is if you sort, so these would be categories of those who strongly believe that fees are more important and that past returns are more important. you can see that the prevalence of thinking that fees are more important than past returns is much higher for those who are financially literate. For those who are not literate, the prevailing view, if they have a view, there's omitted categories here, and a lot of people here would just report that they don't know. They don't know the difference to make this distinction because they don't have financial knowledge. But still, this view that past performance is more important than fees is more prevalent among people that have low financial literacy, which then I think could be potentially dangerous in situations where you make fund selections. Now, I only had 10 minutes. I don't know how I'm doing on time, but I think I'm pretty much done here. But what I just want to highlight is that if you have a system that is open for selection, given also that you have this result where high financially literate people also are more likely to have assets outside of the system, they could basically offset any policy that government come up with, right? Because I have a lot of, people in this room, we have occupational pensions and other savings, so we can sort of offset them. People in these categories are much more vulnerable and potentially constrained, so they have to rely on the government system. I think that's an important point to keep in mind. Now, to round it off, I think the first couple of slides I showed you about the development of the system is that new policies are not created in a vacuum. So there will be market responses and changes in behavior in the market when you make changes. And that has been sort of learned the hard way in the past 25 years in Sweden. I would say that even if we comparatively in Sweden have higher financial knowledge, I'm not sure that having a score of 3 on this fairly simple test is enough to prepare you to make these very difficult choices. So in that respect, I would say that financial literacy is quite low in many cases. We have documented an extensively low financial interest in financial planning, which I think is deeply connected into inertia. So people basically don't make changes once they go into the system. There's a lack of financial engagement, which is very much widespread. From the research I've been doing with my co-authors, I think we can show pretty clearly that confidence is something that drives engagement. This has also been documented in other settings. So for instance, individual stock trading and so forth. So it's not only knowledge, it's sort of the perceived knowledge that drives engagement. And the other important fact is that I think miscalibration, thinking that you know more than you actually know, opens up for making mistakes in making choices. Another thing which is more difficult for policymakers, but I think yet important, is that we find that the willingness to accept advice is negatively related to self-confidence. So, the premise that I think I know already is something that makes me less willing to accept advice. But knowing also that this is more prevalent among people that know less makes this a very difficult problem. So how do you target these users that would be the persons who are most likely to need advice? So I think I'm going to leave you with that. Thank you.
Thank you, Anders. Thank you very much for this overview of the outcomes. And now we're going to hear about what the pension agency does to help people make better choices. I want to welcome Anna Pettersson Westerberg to the stage. Very happy to have you here, Anna. You're the new Director General at the Swedish Pensions Agency. And you have an extensive career in economic policy, both as a politician, so you worked on some of these reforms, and as a civil servant. So the floor is yours to tell us about what the Swedish Pension Agency is doing to help us make better pension choices.
Thank you, Annika, and thank you for the opportunity to talk about pension choices. And it's a pleasure for me to participate with such distinguished speakers and, of course, a knowledgeable audience, and also the moderator, of course. And as Annika said, I've been the Director General for the Swedish Pension Agency for 8 weeks, but I've been working with pensions before. Thank you for 2 very interesting presentations. I will focus entirely on what the Swedish Pension Agency does in the premium pension area, so I won't comment so much on the research. If we start here, what we understand of the scientific research and how the premium pension system has evolved, you can identify some of the basic problems which we have been working, some general challenges in the system. You can see the first challenge, I think, is actually much broader than just the premium pension system and pension choices. It's difficult to understand pensions at all. That is our experience. The proportion of savers who say they know the components, the basic components of the pension system, is about 55%. You know, understanding that there's a public pension scheme and it's an occupational pension scheme. Among the pensioners, it's a bit higher. It's 83% who says they know it pension system contains of. But when we actually test people, what do you really know about the pension system? It's only 30% who could answer the basic question of, okay, I have an occupational pension scheme as well. So this is the first basic problem, I would say. Then, as we've heard today, there are 2 other basic problems. It's difficult to make investment decisions, and especially pension choices. And as Anders described, we also have the complexity of the premium pension system. It's also been subjected to fraud in 2016, and potentially, and this I won't talk anything about today, we will see quite substantial increased income inequality in this system. So this is, I think, a way of summarizing the basic problems of the premium pension system. If we start with the first problem, the Pension Authority has a mission to make pensions more understandable to pension savers and pensioners. So we actually have a government assignment to do this, to increase the knowledge about pensions, to improve financial literacy and prevent procrastination. So every year for the last, I think, about 20 or 25 years, I have Mia in the audience, I think. Here you are. I think it's about 25 years we've been doing this campaign. Yeah, and you're responsible for it today. We send over 8.2 million orange envelopes, mostly digital these days, to pension savers and pensioners. And it's containing an annual statement, how much have I earned this year, the total sum of your savings, but also a pension forecast. And the pension forecast is done in 3 different retirement ages. And this is a way of improving and encouraging a longer working life. We also organize meetings in supermalls, town halls, and so on, where people can come and ask questions. You see some pictures of this when we did it the other week. At the moment, this campaign is ongoing, so we visit 25 cities during 5 weeks. And today, I think we are in Malmö, in the south of Sweden, in this campaign. There's a lot of mass media activities. Johan is also here. He can tell you all about the mass media activities which we are doing to open up and teach the people of Sweden more about pensions. Informing about pension is also an everyday work activity at the Swedish Pension Agency. One of the most used tools in this information campaign and also in our daily work is the website Min Pension, My Pension. This is where you can make pension forecasts of both your public pension scheme and the occupational pension schemes, and also private if you have some. And over 5 million Swedes have made a pension forecast at Min Pension. This basically covers all the pension capital, 98% of the pension capital in Sweden. So the next issue, the investment decision in the premium pension system. As you know, there has been a reform, and Anders told you a bit about this. The recent reform is to move from an application-based platform to a produced platform. And the purpose of this reform is to improve the controllability and the quality of the system, and of course also reducing the risk for fraud. I would say this is basically the main reason for the reform was the scandals of Allra and Falcon. But it's also a way of reducing the risk for large losses for individuals, for specific individuals. I would also say that over the 25 last years, the experience and research of pension savers, the knowledge, the interest of behavior in terms of fund selection have led to this adjustment of the premium pension system. It's been evolving over time. Sorry, I lost some of my... Sorry. And there's been many adjustments of these systems. Actually, it's been 5 large investigations. Even from a Swedish perspective, this is a lot of research and digging into the system to make it easier. The latest was in 2019 and also was leading this change of the system. There's also a new agency who's going to do the fund selection. And Anders mentioned this, so I won't say anything more about it. The other mission for us is that we have a choice architecture in the premium pension system, which will help the pension savers to do an active choice. And this choice is actually regulated by law. And cut some from this socialförsäkringsbalken. And what we are assigned to do in this area is to present options, provide information, and support decision making. And we are supposed to emphasize the default fund as the starting point, and this is written into the law. So this is not a choice from the pension agency. But however, and this is very important, we are neither to put the pension savers in either direction, either to the default fund, the AP7 SOFA, or to make an active decision. So we are neutral in this way. So in our website, we have made a guide, and this is a choice architecture in order to help pension savers to make well-informed pension decisions. And there are some features. Their active fund selectors must, for instance, confirm that they understand the difference of the default fund and an active fund selection before proceeding with the change. So are you certain that you know what kind of choice you do? The choice architecture also include some rules of thumb for long-term pension savings, and this is based on research but also on knowledge. For instance, that fees plays a significant role in long-term pension savings and having a determinal impact on savings in the end. Highlight, of course, the importance of diversification, but also saying that high risk is required for rationally expecting good value development in these schemes. We are also working with this choice architecture and gradually improving it. And at the moment, there are some features which are new and we are trying to introduce at the moment. For instance, a self-diagnostic test. So a bit according to what Anders' research is working with, trying to make people understand what do I know and what do I not know. And this diagnosis test is guiding the users then to choose between the default fund and the active fund selection. We are also introducing these standalone services, and this is a way of helping pension savers to optimize their fund portfolio constructions. One of the newer parts which we are working with at the moment is actually encourage individuals who has made an active decision to revisit the fund portfolio, because we know that some of those who that made an active decision, they never return. It takes very, very long time before you return and have a look at your fund portfolio. So this is something, a summarizing of what we do at the pension agency, and I will stop there for the panel. Thank you.
Anna? So now I would want to welcome James and Anders back to the stage so we can have a discussion, and I will also let you in the audience come in with some questions.
That's a very big question.
But just if you would
Yeah.
think one thing, like
So I think that clearly the role of choice architecture in determining outcomes is large. I do have some new research coming out that suggests it's not as large as you might think, because at least in the U.S. there's a lot of leakage in the system, and so there are many, many ways in which people can undo the well-intentioned effects of choice architecture. In the U.S., the pensions are actually quite liquid before retirement, and so there's a lot of withdrawal from the system, even at relatively young ages. But nonetheless, I think that we kind of do the best that we can, and we try to choose default options and steer people towards things that we think are reasonable. But then at the end of the day, if you live free and die, that's on you.
Anders, what would you say if you would pick one thing?
No, I want to relate back to this and what I said earlier. I think in our system, the premium pension, we have to acknowledge that it's a fairly small part for many people's total pension. So the question is whether we cater this freedom of choice to people that already have a lot of freedom of choice. I think we should focus on the people that are financially constrained here. Those are the people that presumably need to have a higher equity exposure because they would otherwise not have it. So I think more thinking about what the pension system, for whom it is for, rather than thinking about how to tweak different aspects of it.
Who it's really important for.
Exactly.
The people who are restricted, the people you showed in your presentation that are not very knowledgeable and
don't want to save
and it can't offset.
Save.
Yeah. Anna, what would you say? You have a long experience also working with making these reforms happen.
Well, if you see one thing that has been really interesting, I think, is the adjustments of the system. I mean, when we came into it from the 90s, it was like coming from a fairly regulated market in Sweden. We wanted to open up and make it easier to make choices in so many areas, from energy, from also in the pension system. And but this gradual transition who's been done, I think it's good that it's been based on research, but also the understanding of the risks that individuals could get really, really hurt into this system if they don't get their money in the end of their lives. And I think the fraud, the Falcon and Allra scandal was very important, at least from a political perspective. And from the pension agency's perspective, I think the understanding of how much help really people need just to understand pensions at all, but also premium pension, how difficult it is, and that we want to take people in their hands and try to guide them through these choices as good as we can, based on research, based on what we know in behavioral finance and so on. So that's what we are doing, trying to make this system understandable.
Mm-hmm. And James, you worked a lot on the 401k plans in the US, and also your research has been used to actually affect policy, both in corporations and government. What would you say when you look at the changes that have been made in Sweden to the choice architecture and the way the pensions, the mandate for the Swedish pension agency? What are your reflections? Is there anything from the US context that you think we should consider?
I mean, I think that Sweden was kind of famous for having this explosion of choice in the beginning, and I think that Thaler and Cronqvist documented that some crazy things happened.
Some really crazy things happened.
And again, very much against stereotype, at least from the U.S. perspective, where we think that Swedes are all captive to the nanny state. But this incredible amount of choice, I think that it came from a good place. But then I think, as kind of been mentioned, it kind of maybe went overboard. Yeah. And I think that there is a rational scaling back that has happened that is sensible.
So you would say that the curated, you talked a little bit about in the beginning that people could also offset the choice architecture, but it's a step in the right direction.
Yeah, I think that the curation, I mean, particularly because if there is some implicit social safety net or explicit social safety net that is in place for people who have disastrous outcomes, and the state has some public interest in preventing those disastrous outcomes, and if also there's some sense that the system itself requires some level of public trust and faith, then kind of preventing these extreme left tail outcomes is something that is I think, in the interest of the system. So, I think the unfettered choice is something that people should probably indulge in outside of the system, and there should be avenues for them to do that so that they don't feel like they've had their choices unduly restricted overall in their lives.
Well, I think the idea to gear the fund has this background that you have going back to who is investing in the fund, and that these people are more likely to be financially constrained. So I sort of like the idea to have that. I mean, there is always like a political risk here, I think. So I don't know where the limit goes, but say that you have a very geared financial product, at some point in time it might potentially blow up, right? And then you might face yourself in a political situation. So what do you do with all these very disappointed fund holders that have lost 50% of their pension holdings? That's something that I think politicians should think about, at least when you have a contribution system like this.
Anna, what do you say? What do your experience from?
I think, as at seeing that the active decision is going down so heavily, the default fund becomes more and more important. So, of course, it has to work very, very well, and that's also my experience of what's going on. And I thought it was very interesting to hear your presentation about the proportion of stocks and taking high risk, and especially compared to human capital, the composition of your whole portfolio, so to say. And so it seems like very important to have it well functioning.
I think, though, the way that the system is structured right now, where it's only the premium pension in which this particular AP7 default fund is in, I think there's pretty limited scope to increase the risk a lot more, because if you were to try to get the risk level up in the overall portfolio of the pension holder to something that theory would prescribe, talking like 5x, 6x, 7x leverage in that fund, and that's just not something that I think is sustainable, or kind of, because of kind of the narrow framing of what happens in each individual fund. So I think that you would need to have in the system a broader based spreading of the risk, where it's not just the premium pension, but it's the occupational pension that also takes more risk. And my understanding is at least many of these occupational pensions are fairly low risk investments.
They are, and the occupational pensions have also moved to defined contributions. So a lot of, and almost 90% have an occupational pension, and there's pension choice there also. So it's important to look at the complete picture, of course. And I don't think, and then there are different actors deciding, of course, on the investment mix in these two areas. Anna?
I actually made a projection of myself, of my own portfolio in this sense. You shouldn't talk about the age, but getting into middle age. And as you said, the transition is quite substantial at the moment. So many of the young people, they will get an even higher proportion. But 25% of my portfolio is defined contribution. If you add the occupational pension schemes and also the public pension schemes. And as I said, I'm in the middle ages. So the younger generations, they will have even more than 25%. And then, of course, if you also add the AP funds and their share of, which I didn't do in my projection. So it's fairly high, actually. And it's possible to choose quite high risk also in the occupational pension schemes, if you prefer that.
So just to be clear, despite the power of compound interest, economic theory says that actually these young people should not be saving all that much, because the consumption smoothing motive is pretty powerful. Now, that said, if we were to try to encourage savings from a certain portion of the population, and you might decide that actually the young should be saving regardless for whatever reason, tax incentives have actually been shown to be surprisingly weak in inducing more savings. And honestly, compulsory savings is the most powerful way to get people to save. And even though they might undo it a bit on other margins by borrowing more, by saving less outside of the compulsory savings scheme, it's about 30% of that compulsory saving that's undone, and 70% of it does stick.
More reflections on the question, Anna?
But as one perspective of it is at least that we have a very high saving rates in Sweden. If you sort of summarize the public pension scheme and the occupational pension schemes, it's about, if you say 18.5 plus 6, so it's 24%. How much should we save, and for how long are we going to work, and when do we start, and how do we manage our lives in that sense? So I think maybe the problem isn't so large, but I thought it was very interesting to see your research on the contribution rate. It's fixed in Sweden. It's difficult to affect it in a way, but we actually had systems where you pay a higher contributions on the occupational pension schemes in the end of your working life. And this seemed to be a problem because it was the employers pay these fees. So the wage cost for hiring older workers was increasing a lot. It was when you earned your pension rights in the last 5 years of your working life. So, and in the combination of age discrimination, this caused problems for older workers to change jobs and to get a new job because it would seem to be too
expensive.
Too expensive. And I don't know, have you seen that in your research, or is it a problem in the US context?
So just to be clear, this is not my research. This idea of the young should save less and the old should save more. That goes to the 1960s and the pioneering work of Franco Modigliani and others. So I'm just regurgitating old knowledge here. In terms of what does the theory prescribe, I think that you said something interesting, which is that the old scheme required employers to pay a lot more when workers are older, which I agree is going to create problems. No, the theory says that the workers should pay more into the system at the older ages, and so it's really their take-home pay that is kind of smoothed out over the life cycle.
But have you seen, are there systems working where contribution rates actually change with age? Or is it on in the 401k plans, you can voluntarily put in more, right?
So you can voluntarily put in more. Now, there was a little bit of a movement towards that in these auto escalation plans that are becoming quite prevalent in the US, where every year your contribution rate to the scheme increases by 1 percentage point of income. Now, there's an incoherence to this in the sense that people change jobs a lot in the United States. And so every time you change your job, once every 4 years, let's say, you come back to square one.
Okay.
And a more coherent scheme would be indeed an age-based scheme instead of one that's based on how long you've worked at this particular company, in which case you would see rising contribution rates with age that the choice architecture encourages, versus right now, you don't really have that coherence across employers.
Right. And in a Swedish context, then we could have that in our employer occupational plans if we were to introduce that, more likely than in the premium pension, I would think, right?
Circle back to Hans' question, I think that one very big problem is that people don't typically understand the power of compounding. So you have this question of what is the required return to double your money in 10 years, and less than half actually get it right. So I think there's a lot more to do when teaching people about these things. And I know in the US, the CFPB and SEC have initiatives of teaching people these simple tools of thinking about, like the 72 rule and this stuff, to making people aware of how important this is for investments.
I think it's a question actually should be sent to the politicians, because the pension agency don't say anything about people making active choices or not. We are following the assignments and the instructions that we are given, and we are not allowed to, the information that should be neutral. So I think it's actually quite a political issue. But I think when you read the investigation who has been written lately, there is a discussion about this, and you see that there is different parties on the political scale can see this very differently. And you can also see in the text that in parts of the text you can see that you want to emphasize the freedom of choice and providing a freedom of choice, and also the possibility of diversity. But on the other side, you can see also, okay, maybe we should have 3 funds only in the premium pension system. You can see that in the text. But the cost side of this is not so much discussed, I would say, not least in these texts. But maybe it's a question to be asked to the politicians and the Pensionsgruppen, who is up and running again.
Anders?
Yeah, so I don't think that picture actually gives a fair representation, because I think both financial literacy engagement actually increases with age. So you would like to think about this as vintage as well. So people come in, they don't make a choice, but if you look at the same people over time, they're actually starting to make choice. I think that's actually a good thing, that they don't start making choices when they're 20, when they enter the system and never change. It's better for them maybe to wait and be a little bit more financially sophisticated before they start making choices. Having that said, I mean, now we have a default fund, which is sort of half of the total system. At some point, you might want to consider what is the upper limit. Is it 75%, 95%, or where do you draw the limit of having these choices? These are difficult. Now, I also want to say I'm a believer in the freedom of choice, so don't get me wrong here. But my point is that I don't think it should be, expensive to make mistakes in the system. And I think this has been taken care of with this procurement, that taking off, the most expensive funds, or addressing this issue, whether they are frauds and so forth. These are super important for making an efficient system. So having that, you can allow people to make free choices, but the mistakes can't be too costly, I think.
I think, just because people don't choose a fund actively might not mean that they don't value the freedom of choice. So my friend, co-author, advisor David Lapson once told the story about how when he's on an airplane and he's in the window seat, even though he never would actually want to go up and use the lavatory, just the fact that he's in the window seat is very onerous to him psychologically, because he might want to get up and then he would have to create a big to-do. And so just having the option of choosing, even though you don't actually choose, could be something that people value.
I would love to have that data. So most of my research is based on microdata that we can obtain in Sweden right now. But as of now, we don't have the balance sheets of individuals. If we would have, we could have done a lot of interesting research. And that's a takeaway to everyone here who is in policy, that please make this happen, because then we would be able to make much more detailed and informed research about households.
Great ending. More research on household choices. Thank you so much, Professor Choi, Anna, Anders, for a great discussion this morning. There's much more to talk about, so I'm sure we'll see you all again. Thank you so much. And thank you to the audience.